Hi, I'm Nina Melendez, and welcome to LinkedIn News Live, a show about the world of work and our place in it. According to last week's GDP report, the U.S. economy underwent 2 consecutive quarters of contractions, a deceleration that many are already feeling, even if the administration is avoiding saying the R word, recession. Well, today we're going to talk about how the slowdown and rising interest rates are impacting the housing market specifically with an economist from Redfin. But first, let's unpack some of what's happening with the broader economy with LinkedIn's own economist, Corey Kantenga. Corey, welcome.
Hi, Nita. How's it going?
Good to see you. So, Corey, growth has slowed, but employment is still relatively low, and the labor market is as strong as it's been in about 70 years. So, why have we seen this contraction?
Well, so zooming out to the big picture, the million-dollar question is we had a meteoric rise last year, and now we want to know whether we're coming down to Earth in kind of a controlled descent, or are we having a crash landing? And so that's what is the big question out there right now. And if you think about, okay, we saw a contraction in the first quarter, well, you can kind of take that up to technical reasons. There are some very volatile components in GDP, and we had a big increase in the trade deficit. And so you can kind of explain away a first quarter contraction just with some of these volatile components. And you think about the second quarter, well, the second quarter, there's probably a little more in terms of real effects there. So we saw that government spending went down, investment went down, consumption expenditures still stayed fairly strong, but has definitely come down from the first quarter. So one thing to keep in mind about GDP always is that there are revisions. We could be sitting here this time next year talking about how we thought we were in a technical recession and we actually weren't.
Actually, I have a question about that. Is that why people don't really want to call it a recession because it's only 2 quarters, or is
Well,
it? Mhm.
yeah. So, and there's a common rule of thumb that folks say 2 quarters of contraction is a recession. That is not the definition in the United States. The definition in the United States is a broad-based, sustained contraction in economic growth that lasts more than a few months. And that's something that's determined by our scorekeepers, that we call them, the National Bureau of Economic Research. So they usually tell us when the recession started. That's often backdated. So folks are trying to figure out whether we actually are in a recession right now and whether they will, when they actually do make an announcement, whether it will have started now or have started later.
Well, so my next question was going to be how deep is this recession likely to go? But considering that we may kind of not almost be in a recession, let's just talk about it in terms of it just being a contraction then. How much farther down do you think that this might go?
Yeah, so definitely no recession just yet.
Hmm.
You think about the big picture this year. If you were to say that there was a recession from these 2 quarters of contraction, unemployment actually has gone down during this period. And usually, when a recession, unemployment jumps up about half percentage point to 1.5 percentage points. So this would be the weirdest recession that we've ever had if it actually is a recession. And you think about a slowdown. Well, right now, what we're expecting is kind of slower growth that's below trend after the kind of meteoric rise we saw last year. And even a slow growth scenario can be pretty damaging for both employers and job seekers.
So you mentioned unemployment. It's sort of at a healthy 3.6%, I would say. Let's talk about that. What industries are unlikely to see a pullback in job openings if this slowdown continues?
Right. So you think about the pandemic as an earthquake, and now we are living in the aftershock. So there are some industries where those shock waves are still hitting them. So if you think about accommodation, you think about supply chain industries, so transportation and logistics, and then also healthcare. All of those industries are still hurting for talent. They still need folks to work in those industries. So we may see some slowdown there, but we are unlikely to find ourselves in a situation where we have an excess number of nurses, an excess number of medical assistants, excess number of supply chain managers. That is just not the world we are in right now. And then also, when you think about what industries may not see a huge pullback, there are some industries that tend to be fairly stable throughout a recession. So one of those is utilities. Another are different consumer services like personal laundry. Education is a big one that actually tends to sometimes grow. during a recession. And then also, government jobs, because the government usually spends to counter a recession. So we do see jobs in those industries sometimes even grow during downturns.
Corey, thanks for explaining that for us. It's great to have you on.
Thanks so much.
And so let's just talk about now how this is all moving the housing market. Joining us now is Taylor Marr, Deputy Chief Economist at Redfin, where he has been for the past 6 years, a little over 6 years, actually. Prior to that, he was an index analyst at Chicago Booth's Center for Research in Security Prices and a business intelligence analyst at Newstech. He has his master's in economics from Hochschule für Technik und Wirtschaft Berlin and his bachelor's from the University of South Dakota. Taylor, welcome.
Hey, thank you for having me.
How'd I do on that pronunciation, by the way?
Better than I did. I never learned German while I was there and always had a hard time pronouncing lots of words.
Taylor, it's great to have you on. The housing market has been in the news nonstop. We're reading that prices are cooling, but they're still relatively strong. Can you sort of explain that for us?
Yes. So what's happening is that prices are still growing double digits. The latest data from Case-Shiller, that's sort of the industry standard for tracking how fast homes are appreciating, is still at nearly 20% in the latest reading that just came out a week ago. And so, that's really strong by historical standards. But some of the leading indicators that show what's happening in real time with prices, we publish weekly data on sale prices as well as asking prices and price drops and things like this. They're all showing that price growth has been slowing. It's slowed already by more than 5 percentage points over the past couple months. We have reason to believe that given the current level of price drops that are in the market, that prices are continuing to slow. And given the level of interest rates right now, we really do view that prices are going to be slowing to single digits and maybe even decline in some places.
And so that's good, right? If it's slowing, means it's not going to be a crash like what we saw in 2007, 2008.
Yeah, that's exactly right. The prices were growing unsustainably fast, and inevitably we would expect things to slow down. The big question is it a bubble? Are they going to crash? Or is it really just a part of moderation where things come back into more balance like we had before the pandemic as we come down from this sort of pandemic sugar high of everyone rushing to buy a single suburban family home that had more space. And, people were bidding up those prices, 100,000, 200,000 over asking oftentimes. And that is just unsustainable. So that was a brief period, and we're kind of coming down from that, which makes it look like prices are still strong, but cooling quickly.
Yeah, I had a friend who actually bought a house over the pandemic for $300,000 over asking price. And
Wow.
I was shocked. I was like, that's a whole extra house you could have gotten. But yeah, so that's how crazy it was. So the Fed, of course, raising interest rates to kind of tamper all of this down, tamper inflation. Does this mean, though, that at the end of the day, if you're getting a higher interest rate, even if home prices are low, are you still paying relatively the same amount for a house? Are buyers really going to see a difference in how much they're putting down for a home?
There's a lot changing in the market right now. So even if prices continue to cool, interest rates have risen so much since the start of the year. We started the year at basically 3% mortgage interest rates for a 30-year fixed loan. Really low by historical standards, part of the lowest in all of history that we've ever seen. And they've risen, they've nearly doubled that to hitting almost 6% in June. And so that increase in mortgage interest rates made the typical monthly payment on a home rise more than 45% for someone who's shopping for a home. So even as prices do come down, the interest rates are still completely outweighing. And if I had to choose between a low rate and a high priced home versus a high rate and a low priced home, I would rather have more of my money going towards building equity and not into the pockets of banks when you're paying all that interest. The good news is that interest rates have been coming down since they peaked in June. They've come down more than a percentage point. And it is creating a little bit of a window of opportunity for buyers that are in the market today. But prices are still, slow to react. And it's taken a while before homes that sit for a month, before they drop their price by 5% when the buyers aren't there to make an offer. So the housing market is really just slow to price all of this in.
So about a little less than a year ago, we had a show here on LinkedIn News Live about the housing market. And we talked about lumber being one, or just the commodities issues being a component into why prices were so high. It's not quite the same anymore, right? Lumber isn't really causing builders to halt projects at all. Is there something else that we should be keeping an eye on as to what's causing builders to sort of slow down production?
Builders are citing very different reasons today for why they're pulling back than they were citing in their earnings reports or talking about at conferences in the media a year ago. A year ago, it was all, we can't find land, we are having supply chain issues with lumber, and the prices were, escalating to astronomical levels. But now they're all concerned about consumer confidence, the lack of buyers, and mortgage interest rates. And those concerns are cited by Zonda. They track these things for the new home builders. And really the biggest concern is that rising interest rates have priced buyers out of the market. More buyers are opting to just rent or simply stay put on their lower rate. And as such, that new home demand has really dried up at that price. So if prices are able to come down, lumber prices have been falling. If we could do other things to make new construction cheaper, buyers will gladly build a lot more homes. The problem is just the current level of price for a builder to build that home is still very expensive. And we do need the supply in order to make housing overall more affordable. So it's actually a pretty terrible problem right now.
I want to continue on the topic of builders. I want to say hi very quickly to some members who are joining us from all over the world, actually. We've got Samay from Egypt, Powell from California, Linda from Delaware, Errol from London, and Don from Ohio, Gregory from Florida, Shine from Uganda. So thanks everyone for joining across the globe here. If you have any questions for Taylor, he is a deputy chief economist at Redfin. So feel free to put them in the stream and we'll get those answered for you. And I actually do have a question from one member asking, will Florida's housing still stay strong with so many retirement age people moving here and now remote workers?
Florida is a very interesting market. It is
good
iconic for a boom of housing and people relocating there during the pandemic. There was increased reasons for politics as why people were sorting. There were increased reasons for housing affordability, why people were moving to different cities, or even tech workers relocating as they were untethered from places like the Bay Area or New York. What I've seen in Florida is really just a divergence of market activity. So there was a second home boom in some markets on the Gulf where a lot of people are buying second home condos or outside of Orlando, and that's largely dried up. There's been new fees on those second home loans, and that demand has largely gone away this year in the face of higher interest rates. But at the same time, we still have a lot of millennials and young families choosing to move to places like Tampa or St. Augustine and Jacksonville or down in Miami. Miami's housing market has been pretty resilient. Most of the cooling activity we've observed has been largely in the Gulf coastal cities up there, or out in the west region of the U.S. The eastern part of Florida, as well as southern Florida, has actually remained pretty resilient to the housing market changes. And even going forward, there's still a lot of migration happening into Florida. I view the long term for Florida to actually be still pretty strong in light of the housing affordability challenges in the Northeast or other states. So Florida continues to be a great place to attract people for affordable housing, but there's some segments of demands that have really changed shape.
I think that was a great question. Thanks for asking it. I've got just another question very quickly about the building. So if builders stop building, because there aren't enough buyers, say, doesn't that just mean that the U.S. will eventually have a housing shortage once demand returns?
We do have a housing shortage already and continue to have a housing shortage. The number of homes that are coming on the market each month is just not keeping pace with, how many buyers are out there and actually want to buy a home. We've only slowly started to see a buildup of inventory as homes take longer to sell, but not as much from, the net number of homes that are hitting the market or from builders supplying housing to the market. When you look at the demographics of young millennials hitting their prime home buying age, we really need 3 to 5 million more homes on our U.S. housing market in order to supply that demand without, further worsening our housing affordability challenges. So as builders pull back because there aren't buyers who are able to buy at that exact price, given the challenge of interest rates pricing out those buyers, we need to find other ways in order to create this supply. So Zoning reform to build more affordable multifamily units is something that's underway in a lot of cities, and will continue to be a shift of builders building more multifamily units. That will be one positive angle that will happen and is already slowly starting to shift this year. But otherwise, there's a lot of government programs or policies that could also encourage building housing supply in the face of low demand. So that way, in normal times and strong times, we have less affordability constraints for why people aren't building well through housing.
So 3 to 5 million sounds like a lot of homes that are still needed to build. Does that just sound like a lot to me, or is that sort of
it is a lot.
Does that sound like a lot of homes? 3 to 5 million.
That is a lot of housing, especially in California in particular. That's emblematic of the worst of the nation's housing shortage, where there's millions of households there that really are in the place where they should be buying their own home, but due to a lack of affordable housing, they're not able to purchase real estate. So you have multiple households that are really combined into one house, and household formation is lower. And so as such, there really is just not enough building activity. Most of what's happening, though, is that people are just leaving the state and going to places that are building that housing. That's why Florida, Texas, Tennessee, Arizona all continue to grow. It's just from a wave of people leaving places that aren't building enough housing and into places that really make it easier to build.
And are you seeing demand for single-family homes or for condos? Where's the demand most these days?
Ever since the pandemic started, single-family demand has completely surpassed condo or even townhome demand. Before the pandemic, there was really a season of 5 to 7 years where there was a big urban revival. Condo prices close to the city center and walkable neighborhoods were in high demand. But since the pandemic, people don't want to share space. They don't want to share walls. They want outdoor space, a home office. And we've seen demand really shift towards the single-family segment of the market. As the market started to cool, we've seen condo sales fall twice as fast as single-family homes, and their prices and their price growth is also lower. So demand is still holding up a bit stronger in the single-family market.
Let's say hi to some more members joining. Rodub Fel from Mexico, Marie from Montreal, Elaine from Texas, Gabriel from Nigeria, Dolores from Texas. Hi, Dolores. Thanks for joining the show again. We've got a question from Errol. Errol asks, do you think that we will have a housing market crisis by 2026, as there seems to be a pattern every 14 years? Taylor, what do you think? A housing market crisis by 2026?
Well, the business cycle, particularly as it relates to the housing market in particular, does not follow these cyclical time periods. The duration between housing booms and busts is not timed out like a ticking time bomb. In fact, if you look at a lot of other countries, they've had multiple decades of continued steady growth in housing, whether it's home prices or housing construction and sales. So there's no reason to think that just over a certain period of time, we would expect a crash or sort of a reset. In fact, even during the great housing bubble and financial crisis, a lot of markets like in Canada or other places didn't even fall and held up pretty well. And, now are showing signs of cooling, but just to say that doesn't always follow the business cycle exactly, but oftentimes can be leading the business cycle. So right now, I would say we are in a housing recession. Activity has sustainably fell consistently since the start of this year. And it's a key driver in why the second quarter GDP that we just discussed actually declined. Residential investment fell 14% and really was dragging down GDP. So the housing sector could also lead us into the recovery as interest rates have been falling, and they could end up resulting in buyer demand rebounding a little bit if they fall far enough. But we're not to that point yet.
So Redfin services more than 95 markets across the US and Canada. In what geographies would you say that you're seeing the biggest price declines?
First and foremost, the Bay Area and Seattle, these tech hubs, where the NASDAQ is down about 30% year to date at the end of June. I think it's still in a bear market territory, maybe 24% down or something. And a lot of these economies out in the West, especially the secondary tech hubs like Denver and Portland, and then into Austin, all of those markets have really seen a big impact from the high concentration of tech sector. And think about the spillovers that every tech worker plays in their economy with remodeling their home, with buying goods and services in their local economy. So really just the tech decline from financial markets as well as tech hiring has been slower than the rest of the overall economy, even though the labor market is still pretty tight, as your last guest mentioned. The tech sector in particular has been instituting many hiring freezes. And as such, those markets
layoffs, laying off, not just freezing, just like laying off their staff.
And layoffs. And so as such, those markets that have a high concentration of tech jobs and tech workers are cooling off much faster. Price growth has been slowing. In fact, San Francisco is the only city in the country that we've been tracking that actually had a year-over-year price decline and continues to actually slow down and into a negative territory. More markets are at risk for falling into negative year-over-year growth. It doesn't mean everyone's home will lose their value. It might be specific neighborhoods, and it kind of depends on what you compare it to. If you bought 3 years ago, you could see a price decline of 5 or 10% and still be ahead of where you were 3 years ago, just because of the massive boom that these places had from also tech workers had a boom that piled in cash into these markets in 2021. So that's kind of the state of where we're at in the markets that are seeing the biggest reaction right now.
And Taylor, I've got another question for you also about geographies. Leslie asks, what do you see for the New York metro area, specifically North Jersey? That's very specific. Will prices come down? And I actually want to ask, let me just say the tri-state area, right? Connecticut, New Jersey, New York. Are you, what are you seeing for prices there?
So I don't know specifically about, different neighborhoods within the New York metro area and what that looks like. But what I can say is more broadly, the Northeast and the New York region in particular is fairly resilient right now. It's not showing up in many of our indicators of markets cooling quickly or, major softness. There was a big outflow of people leaving the New York metro during the pandemic that was, only close to the Bay Area in terms of the magnitude of the pandemic shift of migration and out migration. But then the New York metro area started to retain and attract some new younger households as they moved into the area. And so as such, the rental market's been very strong in that area. The suburbs outside of New York City continue to be pretty strong as they are still relatively affordable, and hybrid remote work is sort of the reality today for a lot of New York jobs. So overall, I've seen it hold up relatively strong. Our outlook is that the Northeast and the Midwest in particular are just faring pretty well compared to the West region. So, I would probably say North Jersey is probably average in there, but I don't know in particular.
And another question, Taylor, you're very popular. So many questions for you today. Jesse asks, do you think higher rent is linked to the ownership groups investing in upgrading buildings? Or is it more closely associated with corporate greed? Let's answer that. The first part of that. So, do you think higher rent is linked to the ownership groups investing in upgrading buildings?
So maybe I don't understand exactly what that means, but what I think it means is we have all these institutional buyers. We track institutional investment into housing. It hit a record high in the first quarter of this year. At about 1 in 5 homes that were purchased by institutional investors. Some of those are just flipping homes, but a lot of those are actually buying those homes to then rent them out on the rental market. The rental market has been very strong, and by doing so, they can capitalize on all this strong demand. They tend to charge higher rents on average than your mom and pop landlord. And there's kind of mixed evidence as to about the quality and the service that you get from all of those, corporate landlords or institutional owners. So it's hard to say, but overall, there has been published evidence that, they do charge higher rents and that their rents are growing faster, especially as they play an increased role in the housing market.
And as they charge higher rents, then the neighboring properties as well will charge higher rents and just overall raises the prices in that area. Is that correct? Is that how it works?
It could, up into a point. And then, then you have to deal with, if you're charging a higher price, but there's not enough renters who really want that unit at that price, then you'll start to see vacancy rates creep up. we're still at a record low level of vacancies, according to the Census Bureau. And it's going to be a while, even at today's rent growth, before we really start to see homes sit on the market vacant because they're charging too high of rent to find a renter. I think that these landlords and institutions want to get ahead of that. No one likes having units sit empty and not collect rent. So we've already heard a lot of incentives of free months rent or other things to sort of get ahead of having to bring rents down too much, or homes just sit vacant. So that's kind of what's happening right now.
And last question we have time for from our guests, or from our members. Trevor is asking, where do you expect interest rates to stabilize if economists' expectations for inflation cooling off next year are accurate?
That's a great question. So with interest rates, I do just want to clarify that the Fed has been raising rates. Everyone's probably seen those news stories. The Fed raised rates for the second time of 75 basis points just last week. And it's sort of a record pace at to which they're raising short-term interest rates in the past more than 4 decades. But in the housing industry, we track mortgage interest rates, which don't move in lockstep with what the Fed is doing, and oftentimes can move in opposite directions, as we're experiencing right now. So as the Fed raised rates, we actually saw mortgage rates fall more than half a point over this past week, and mortgage rates are continuing to kind of trend downwards and be past their peak period of June. The outlook on the forecast for interest rates are all over the place. We don't know what's going to happen. Some people have been saying interest rates will sort of trend towards 6, and that'll be the steady state. But actually, my own forecast, as well as some others, are that they'll stabilize closer to 5, maybe just a tad under 5, depending on recession fears. And that's really what's driving some of the rates to fall recently, is just signs of slowing economic growth, recession fears. And as that continues to play out in the market, we could see rates even go lower and sort of pull back some home buying demand. But the consensus is somewhere in that range, 4 to 6 rates. We don't think we'll hit 3% again, and we don't think it'll really go beyond 6% anytime soon.
Taylor, before I let you go, what do you think is happening right now in the housing market conversation that people are just not paying enough attention to? Or what's missing in these conversations that you think that we should not be missing?
I think there's several factors related to the rent versus own equation. A lot of people that are first-time buyers are priced out of buying their first home and switching to stay in the rental market if they're, renting, and that creates extra demand. Or if they're moving to a new city, maybe they wanted to buy but are just priced out of buying a home, and so it creates demand for the rental market. And this is something that's continuing to keep rents elevated and growing faster than home prices, even as real estate prices start to slow down. So that rent versus own equation is key to understanding inflation, and sort of as housing is one of the major drivers, just second to gas prices, for inflation today. The other thing is migration. People have been relocating in massive amounts, especially for housing-related reasons in particular, and less so than job-related reasons during the pandemic. And so as people continue to relocate and search for more affordable markets, I think it's as important as ever to pay attention to where people are moving and how these cities can adapt to accommodate this growth or welcome the growth, and as to the reasons for why people are moving. So migration continues to be elevated in our tracker of migration at a record high level, from more than well above the pandemic levels even.
Taylor, thank you so much for coming on and letting us pick your brain. We appreciate it.
Thanks for having me. This was fun.
That was Taylor Marr, Deputy Chief Economist at Redfin. And thank you for everyone who submitted questions and comments. We're so sorry we couldn't get to all of them, but you can continue the conversation here, or you can check out some of our other stories to the right of your feed. Or if you're on mobile, you can just click into the search box. I'm Nina Melendez. Thanks again for watching LinkedIn News Live. See you next week.